For decades, the world's biggest banks secretly rigged the price of money itself, your mortgage, your debt, your future. It was called LIBOR. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. For years, the most powerful number in global finance was something almost no one outside the industry had ever heard of: LIBOR, the London Interbank Offered Rate. It wasn't a stock or a bond, it was the price of money itself. Each day, major banks, names like Barclays, JP Morgan, and Deutsche Bank, were asked a single question. If you had to borrow from another big bank today, what interest rate would they charge you? Every morning, each bank submitted its answer. The highest and lowest were thrown out, and the rest were averaged. That average became the official LIBOR for the day. Simple, elegant, and, as it turned out, catastrophically naive. Because those numbers weren't based on real transactions. They were based on trust, the assumption that trillion-dollar institutions would tell the truth. And in high finance, trust is the easiest thing to weaponize. To understand why this mattered, we have to step back. LIBOR wasn't just a number for banks, it was the benchmark for almost everything. Over $350 trillion in financial contracts worldwide. That includes corporate loans, student loans, mortgages, and credit cards. When you paid interest on your mortgage, when your student debt accrued another dollar, LIBOR was the invisible reference point that decided the cost. It was the heartbeat of the global financial system, a number so embedded that economists called it the world's most important rate. Yet this global benchmark was built on nothing more than a few banks guessing what they thought borrowing might cost. It was like letting students grade their own exams and then paying them bonuses based on how high they scored. At first it worked. The system seemed stable and self-regulating, but inside those banks a quiet realization spread. If a tiny adjustment in the rate could move trillions of dollars, then whoever influenced that number had real invisible power. And power in finance is never left unused. So how exactly did they manipulate it? Here's the simplest way to understand. Imagine 16 banks are asked what rate they'd pay to borrow today. They each send a number. Now, imagine one trader at one of those banks holds a massive bet. A derivative contract that pays off if interest rates go up or down. If the trader knows LIBOR will rise, he can position his trades to make millions. But why wait for it to rise naturally when he can nudge it himself? He messages a friend in the bank's money market desk, the team that submits the daily rate. Hey, can you lowball LIBOR a bit today? Need it down a few points. The colleague adjusts the number slightly and sends it in. When all 16 banks submit their figures, that tiny adjustment shifts the average. LIBOR falls, maybe by 1/100%. It doesn't sound like much, but when trillions of dollars in contracts are tied to that number, even 1/100% means billions move instantly, and every time the rate moved, the traders who nudged it collected the winnings. It wasn't complicated, it was subtle, and that made it perfect. Because no one was checking. The British Bankers Association, which oversaw LIBOR, assumed big banks would never lie. Regulators in London and New York trusted the system. And for decades, it seemed to work, until it didn't. By the early 2000s, this quiet manipulation had evolved into open collusion. Traders across continents coordinated in secret chat rooms with names like the cartel. Their conversations, later uncovered by investigators, read like scenes from a heist movie. Can you move 3-month LIBOR down a tick today? Sure, mate, no worries. You owe me a bottle. They joked about fixing the fix and sent each other champagne. All while moving billions that affected everything from municipal pensions to family mortgages. This wasn't rogue trading, it was routine. By 2007, the housing market was cracking. The financial system was loaded with risk, and LIBOR, the very number meant to measure trust between banks, became fiction. When the global crisis hit in 2008, banks didn't trust each other enough to lend, but they didn't want to show it, so they began reporting lower borrowing rates, pretending they were healthy and stable. In reality, the interbank market had frozen. The system's heartbeat was flatlining. LIBOR, one economist later said, was the thermometer that said 98 degrees while the patient was in cardiac arrest. Banks lied to save face. Regulators looked the other way to prevent panic. The irony was complete. The very index created to measure trust became a global symbol of deception. The truth finally surfaced in 2012. Whistleblowers, journalists, and investigators exposed the extent of the manipulation. It started with Barclays Bank, which admitted to rigging LIBOR and handed over chat transcripts. The tone of those messages was astonishing, not because of what they revealed, but because of how casual it all was. These weren't criminal masterminds. They were ordinary traders, joking about distorting the global financial system as if it were a game. When questioned, one Barclays employee famously said, "We all did it," and he wasn't wrong. The scandal spread like wildfire. UBS, Deutsche Bank, JP Morgan, Citigroup, and the Royal Bank of Scotland were all implicated. Each had manipulated LIBOR to either profit from trading positions or to make themselves look financially stronger. It wasn't one bad actor. It was the entire system incentivized to cheat. Regulators launched investigations. Governments demanded accountability. By the time the dust settled, the fines had reached nearly $9 billion. But that number, while impressive in headlines, was insignificant compared to the profits the manipulation had generated. $9 billion was the cost of doing business, not a punishment. A few traders were charged, some even jailed. But they were scapegoats. The institutions themselves survived untouched. Executives resigned, bonuses continued, and within months business resumed as if nothing had happened. And that was part of the genius. When the crime is too complex to explain in a headline, accountability dissolves into abstraction. The mechanics were deceptively simple. Traders didn't need to hack the system. They were the system. They understood that financial markets move not on morality, but on incentives. And the incentive was always profit. LIBOR wasn't determined by public auctions or transparent data. It was a survey, a daily poll of bankers who filled in the blanks however they pleased. When you give absolute discretion to profit-driven institutions, you don't get objectivity, you get choreography. When the scandal broke, governments faced an impossible dilemma: expose the full extent and risk, eroding faith in the system, or contain it quietly and move on. They chose containment. Committees were formed, reports were issued, and a new rate was promised, one based on real transactions instead of estimates. LIBOR was officially retired in 2023. Its replacement SOFR is based on actual data. In theory, it's cleaner, safer, more transparent. But in practice, it still depends on the same institutions and the same culture. The names have changed. The behavior hasn't. Because the LIBOR scandal wasn't really about interest rates. It was about trust. The kind of trust that underpins every financial contract. The kind of trust that collapses silently, not with explosions, but with emails and spreadsheets that no one double-checks. When you think about the financial system, it's easy to imagine it as cold and mechanical. But beneath the surface, it runs on human psychology. Greed, fear, reputation. LIBOR turned those impulses into numbers, and those numbers into power. The manipulation of LIBOR wasn't victimless. It was a silent tax extracted from every borrower in the world. And yet it barely made the evening news because the victims weren't visible and the villains wore ties. There were no dramatic collapses, just fractions of percentages, invisible but compounding, siphoning wealth from the many to the few. That's the quiet genius of systemic corruption. It hides not in chaos, but in order. When deception becomes part of the daily process, it stops being seen as a crime. It becomes how things work. In the end, the LIBOR scandal revealed something uncomfortable. The global financial system isn't built on precision. It's built on confidence. When that confidence breaks, the numbers keep printing, but the foundation cracks. The price of money isn't just a statistic. It's a story about who decides, who benefits, and who believes. LIBOR's fall was a reminder that the people who control the world's money don't need to break the rules. They just need to write them. And maybe the most unsettling truth is this: the manipulation never really stopped. It just evolved. The LIBOR scandal wasn't a glitch in capitalism. It was capitalism, stripped of its illusion. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.